You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Wednesday. Today, we're going to talk about 5 stocks trading at their 52-week low to put on your list. Tariff edition, and tomorrow we have another 5 stocks, non-tariff edition necessarily. I know you guys, when the market goes down, it sucks because you see your portfolio value going down, but it is also the time to see if there are any opportunities out there, right? Like sometimes it's just like a great time to use that dry powder. Quick note on that though, I'm not a super fan of just like buying stocks at 52 weeks low. First, sometimes just like short-term fluctuation doesn't mean that much. And I rather invest in quality stocks a lot more over than to just look at the price fluctuation, regardless if it's going high or it's going low. And in my experience, I bought many stocks at not their 52 weeks high, but rather their 5 years high and still made a ton of money. So the price is one metric, but it's not all. And most of the time, to be honest, when you look at it with a stock and you're just like, oh, the stock is down now 10-15%, it's a great opportunity. Well, it probably just trades like the same price a year or year and a half ago. And therefore, like 18 months ago, you thought it was like too expensive. Today's still the same price, but now it's better because it's going down from its peak value that happened like 6 months ago. Sometimes like you're just playing tricks with your mind. So anyways, let's get it started. Richey Hardware, rch.to, selling a lot of small pieces of hardware for the construction business. So everything that goes into like your like for cabinets into your kitchen or your bathroom and stuff like that. They're selling over 100,000 different pieces of hardware. 61 centers in the US, 48 centers in Canada. So a lot of distribution in North America, of course. 3 manufacturing plants in Canada. So that's probably where it's going to hurt if there are tariffs on the stuff that they sell. Most of the stuff is made in Canada. So if it crosses the borders, we'll have to see how it goes. Recent quarter was quite mixed results. Revenue were up 5%, but earnings per share down 15%. The earnings were hurt on weaker margin. Inflation is kicking in, so increased cost of goods sold. Expansion project as well, which actually at least the expansion project is good. They're spending money now for the future, showing some confidence in the future. And again, told you that many times before, your portfolio and the stock market will outlive Trump's presidency. Your portfolio is not going to die in 4 years, and life is going to continue. The other thing is, I don't believe that Trump is going to damage the market every single day for the next 4 years. He's going to stop at one point. He's a businessman. He doesn't want to create the largest recession ever for his country and be in the history book for that. So, there you go. Probably that we're going to see some tariff being smooth, or I don't know, like so far, those are actually changing every 15 minutes. So do not modify your portfolio to match tariffs, because the only person that's going to be a winner there is your broker, because he's going to make a killing while you're selling and buying stocks every single day. One last thing for Richey Hardware, they increased their dividend by 2%. It's not much, but at least it's something. Shows some confidence for the future as well. Moving on to number 2, Adentra. So ADEN.TO. Changed their name. I think it was like Hardwood or something like that before that. They are selling building products for residential and commercial construction market. Sorry, guys, notification that just come in. That's the joy of recording and with not editing anything. Anyways, so Adentra, the company is selling mostly to industrial customers, so 55% to industrial, 31% to pro dealers, so those are like contractors, and then 14% to home centers. So you're gonna see those products into the like the Ronas, the Home Depots, the Lowe's, and so on. 86 locations. The revenue is 92% coming from the US, 8% from Canada. So you may be thinking, oh my God, like that's crazy. They're going to get hit by the tariff. But then if you dig a little bit deeper, that's interesting because management said in their latest quarterly earnings, 90% of our operations is based in the US and an estimated of 92% of purchases are not impacted by tariffs. 92%. So again, sometimes pull the trigger too fast. Of course, there are other reasons why the stock is trading around its 52-week low. Latest quarter was not that great. Revenue up 3%, earnings per share down 18%, hurt by higher costs, higher amortization, and also the Wolf business acquisition. So again, when you see Richey your hardware going down, earnings per share is down 15%. Adentra going down, earnings per share down 18%. So you can see that there's a relationship between how much you're making per share and the stock price. So just one last note on this one for Adentra. What I loved is they expect still growth going forward. So another sign that companies are going to survive the next 4 years. They expect to grow their business from 2.2 sales in 23 all the way up to 3.5 billions in sales for 2018. 700 million should be coming from acquisition, another 500 from organic growth. So management is quite bullish on the company. So we'll see how it goes. Number 3, Stella Jones, one company in my portfolio. We're talking about like 47% selling utility poles, 25% railway ties, so 75% of the business like incredibly solid and recession resistant. Not necessarily like the place where you're going to find the most growth though. Residential lumber, 19%, industrial products 5%, and then logs and numbers, the rest of it. 70% of their business is made in the US, but they do have manufacturing plants over there as well. So there are two things here. They may be affected by like the cost of lumber, of course, because even though they're not selling much residential lumber, you still need lumber to create like utility poles and railway ties. That's one. But on the other side, those are like long-term contract and there are not that many competitors out there. So it's a little bit harder to find a replacement for those products. That should help them. Latest quarter, revenue up 6%. Earnings per share down 5%, though. Another mixed quarter, so that's also explaining why the stock is not going that well. Unfavorable sales mix, but the dividend was up 11%. So that's a good thing. Taking a quick pause here to invite you to my next webinar, which is tomorrow, moosemarkets.com/webinar, all about how to clean up your portfolio and get ready for what's coming up. If you're thinking, oh, it's not the right time, it's uncertainties right now, the stock market is down. Well, what if your portfolio has major weaknesses and you're just too afraid to look at them? Well, if they are major weaknesses and we get into a recession, there will be a market correction and your portfolio is going to get hurt a lot more. So now is the time to clean it up. moosemarkets.com/webinar. Latest two transporting companies. We're going to make them quick because you know them already. Canadian National Railway. CNR.TO, 19,000 miles of railroads going from Prince Rupert and Vancouver all the way to the east to Halifax, going through all the major hubs like Edmonton, Winnipeg, the Great Lakes, Toronto, Montreal, and all the way down south to New Orleans, passing by Chicago. So economies of scales, of course, but transportation, we're thinking about the recession, we're thinking about tariffs. They're going to be like weaker volumes there. And it already started. Latest quarter, revenue down 3%, earnings per share down 10%, mostly due to lower volume. So it costs more because, you still have to maintain those trains, even though you're not using them. So that costs more. That's why the earnings are down. And the latest, but not the least, but definitely the one that got hurt big time, TFI International, TFI.TO. Huge trucking network, 14,000 drivers, 650 facilities. 30% of their business in Canada, 70% in the US. Almost half of the business, 44%, is less than truckload. So clients that are paying for a part of a truckload, but not completely, so they pay a premium. And then TFI International is using their wide distribution network to fill those trucks. 35% truckload, 22% logistic. Of course, it's a game of economies of scales and growth by acquisition. We fear a recession. We're thinking that with tariffs, we're going to have less transportation going on. CNR getting hurt, TFI is getting hurt. TFI was worst. I mean, because latest quarter revenue up actually 5%. So you're thinking, oh, that's not that bad, but earnings per share down 30%. And management said, you know what, it's going to continue throughout 2025. It's going to be a very rough year. So they made an amazing job at putting the expectation super low for 25, but that, of course, drove the stock price down double digit. I think it was down like what, minus 20, 25, or even 30%. Kind of like following the earnings per share expectation for 25. So see that there's a link here. So not a good quarter, maybe a good buying opportunity, but be ready to get into a big roller coaster for this one. TFI International is known for this volatility. So better make sure that if you invest in this one, you know what you're doing. Full disclaimer from this episode, I do have shares of Stella Jones and Canadian National Railways. I do not intend to make any modification to my portfolio at this point, looking at those five. But I mean, CNR is looking very good in my opinion right now. You just have to be quite patient. That's like number one quality for investors, right? So, right, Moose, do not forget to subscribe to the webinar for tomorrow to get the replay. moosemarkets.com/webinar. And tomorrow we're going to talk about 5 stocks trading at their 52 weeks low, but they're not necessarily linked to the tariff. So that's going to be super interesting. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.